the gaps that I want to really focus on in this particular workshop are the gaps related to news of some sort, mostly earnings gaps, but the ones that come with volume. So let me go ahead and show you first of all what I'm talking about. So here, for instance, on Costco, and this is just going to be used as an example just to show you any old gap. Yesterday, now on these red filled candles, the gap or the open on a red filled candle is at the top of the rectangular body. So it opened yesterday, and one way you can double check it is click this inspect button and come over here. You can see that Costco yesterday opened at 222.85. The day before, it had closed at 220.06. So it had opened up $2.80 roughly. Now, you might say, well, why? What happened to Costco? Well, nothing happened to Costco. But if you remember, yesterday morning, the futures were way up. So the overall market was moving higher. And therefore, many stocks simply gapped up because the overall market was strong. No news, at least I'm not aware of any news that came out on Costco yesterday. But we just had this gap up. And what most gaps are just that, common gaps, where they're not really news related. They're just, could be the overall market. It could be something in the sector, one sector, maybe the defensive stocks have an edge. And so if a company is part of that defensive sector, they'll get a little bit of a gap and a move higher at the open. Most of these common gaps will do what we call fill the gap. And that simply means that after you go gap up from the prior close, you go back down and you test that prior close. Now, with no news, usually there's light volume. And if you look at the intraday chart yesterday from Costco, just pull up a 10-minute, 5-day chart. You can see this is where it closed after the shortened holiday session from Friday. So here was your close at 219 and change. Here was your open up at 222. And after that open, and you can see volume just kind of so-so for Costco, nothing huge. But after that gap up, we simply went back down, filled the gap. And then Costco went down a little further. Now it's rallying back. But that back and forth is very normal in the stock market on a regular daily basis. You have a lot of individual stocks that will make that move up or down at the open and then kind of come back at some point and fill the gap, maybe that day or the next day or within a couple of days. But usually those gaps are filled. I'm going to focus more on gaps resulting from major news. And most of my trading revolves around earnings gaps. So that'll be the majority of what we talk about today. But let me go ahead and I'm going to go through, and what we're going to do today is just look at a lot of charts. When I studied gaps, this is really what I did is I just looked at hundreds and hundreds and hundreds of charts, literally thousands of charts over the years, and just started to get my eye trained on a lot of reversals that take place at key areas after gaps take place. So what we're going to do is take a look at a number of individual stocks and then just hopefully this will shed some light and give you some things maybe to look at if you don't already trade gaps, some things that maybe might perk your interest as far as short-term trading, if you do like to short-term trade. So let's start off with the first one here. This is Five9 Inc., FIVN. Now you can see back in August, look at the volume here. The stock had closed around $35. The next day it opens almost at 40. I can tell you that was an earnings-related gap. So the company came out, beat top line, beat bottom line, Wall Street estimates, and you can see the market's reaction was very powerfully bullish to the upside. Now, after it gapped up, one of the things I really like to focus on is what kind of candle prints. And in this case, you can see a really nice hollow candle. And for those of you who don't follow candlesticks, what this hollow candle is telling us is that Five9 gapped up to almost $40, but didn't close that day until it had gotten up to almost 44. So when you think about a gap up, and if you understand how the market works, when everybody wants to buy, like they did here at this open after the really solid earnings report, market makers are on the other side of the trade. They're the ones that provide liquidity. So the big thing that when you're looking at gaps, the thing that stands out to me is you're really starting to get an indication of what market makers are doing with a stock, at least For me, that's the way I interpret it. So in this case, you can see FIVN gaps up, very heavy volume, but notice we hardly come down at all that particular day before we took back off and went even higher. So what that tells me is that market makers, which typically are going to be on the other side of the trade because they provide liquidity both on the long and short side in the very near term in the market, they're going to be on the short side selling into everyone else buying because they're going to be on the other side of those trades. But when you get a hollow candle like this on very heavy volume, it's telling you that market makers really were not able to gain control of the action, because normally after a gap up, we talk about a gap fill, which I just discussed. Well, that would require a lot of selling to take place to get the stock all the way back down to 35. In this case, it continued pushing higher. There was too much volume. Market makers have a lot of capital, but they have limited capital, and they're not going to get in front of a freight train. When everybody wants to buy a stock, they're going to eventually give in, and that's why you're going to see these really bullish candles. And if you notice, over the course of the next 2 or 3 weeks, FIVN 59 continued moving higher until it finally topped in about the $48, $49 area and then started rolling over. Now, at this point, once you reach a top and you can see that false breakout, that last ditch effort to move higher there, lesser volume, long tail to the top. At this point, it's easier for market makers to gain control on the short side. And so it's not too surprising to see a stock at least pull back to a moving average. In this case, we went right through it, and we kept working our way. Now, it took about 2.5 months, but FIVN went all the way back down to gap support. It did fill the gap, but it took a while. And so when I'm looking at a chart and I put a stock like this on my list to buy, I'll usually annotate my charts showing gap support at the top, a lot of times gap support at the bottom. I could maybe sometimes even annotate a price support level. Like, let's say this high had been up here at about 42. Then this candle would have broken above that prior high and would have established price support at 42 going forward. So that might have been another line that I may have drawn on a chart. But I usually just put these support resistance lines on a chart just to kind of quickly allow me to zero in on some of the levels where I'd be looking for maybe a reversal. Now, if you look at FIVN, we didn't reverse at the top. That was a little surprising. And I don't think this one I had. But if I had bought this, I might have bought right about the time it came down and tested the top of gap support. And I'll be showing you a number of charts where you'll see exactly what I'm talking about, where that provides great support. But in this case, we went down, bounced one time, stayed under that 20-day, and we went all the way down. And even on an intraday basis, we went below gap support. That move below gap support intraday and then coming back up and holding it, that to me is pretty significant, because when you're breaking down like this below gap support, if I was looking to get into a stock, I'm not going to get into a stock that's looking like it's breaking down below that gap support level. I don't know that this is going to turn around intraday. When I see gap support being lost, I start looking at the next support level, which would have been all the way down here at about 32. But the fact that it came down below that support level, gap support level, and reversed suggested that we might be in a pretty good position there for a quick reversal to the upside. And the beauty of it is you can keep your stop really tight because you're down near support. Problem is, when you get in, a lot of folks just get in whenever. If you get in up here and you're looking for a support level to put in a stop, I mean, I would be looking maybe at the 20-day. Beyond the 20-day, maybe a little bit of price support at 44. Then I'm looking down here at 39.5, and then I've got gaps. I mean, this is what gets you into trouble, is buying a stock and then holding it and letting the losses mount before you finally say, "Hey, I need to get out of this." If you start making emotional decisions, you're going to lose money, no doubt about it. So you want to try to be as business-like as you can. Notice also on this reversal, I had connected the trend line here. If you can find multiple reasons why a stock looks good at a certain level, the more reasons, the merrier. I want to know that there might be folks buying because they see the trend line support. I know some people might be buying because they see this gap support. Some people might be buying because off of a downtrend, they see a hammer. there's a lot of different reasons why folks might be buying this stock. The more, the merrier, no doubt about it. So anyway, I just wanted to point out, you can see the gap support held here. Next time we came down here, same thing. We hit the same level and bounced off of it. So it can provide clues, not just for one trade, sometimes multiple trades. Now, I went through a lot of explanation there, but I'm going to go through a lot of these other charts much quicker so that you can get a feel for a lot more charts. But here is AeroVironment, small company, gap up. Again, look at the volume coming in on this gap up and the huge move to the upside, continuing high volume. That tells me there's a lot of accumulation taking place. But once again, look what happens afterwards. If you're patient, many times these stocks will come back to you. Came all the way back down. In this case, went just slightly below gap support and then reversed. Now, I might look at this, and if I had bought, I might have gotten stopped out on that. But if I hadn't bought at that point, on this next day, it's kind of like a piercing candle off of a downtrend, and it came back up and held this support level. And if you think about it, if you combined these 2 days' actions, and if you could imagine what that candlestick would look like, you would have opened up at that 90 level. You would have come down to the low here the next day of around 84, and then the close that day is up around 88. These two candles combined would have been like a hammer. Now, you know, you might have problems visualizing that, but if a hammer had printed here, I'd have been all over it. Well, if you see two candles that kind of do the same thing, you have the breakdown and then the reversal coming back up to hold support, that can get you in with a fairly tight stop, just a few dollars to the downside, and then a rally. I think AVAV was actually a setup that I went over maybe a few weeks ago off of that move, off of that support area on that reversal. So, I think it was right at the end of October. But anyway, this is another one where if you watch this gap support level, it's so far been holding over here again a second time. HD Supply Holdings. Now, a couple things here. Notice here's a gap up. Now, I'm going all the way back to June, but big volume, gap up. I do believe that was earnings related right here. And notice that top of gap support, we never went back and filled for the next couple months. But every time we came down and hit this top of gap support, we bounced off of it, creating some short-term trading opportunities with a fairly tight stop. Now, with the earnings that came out in September, the stock sells off, and you can see the volume pretty strong. But the thing that really, we did bounce the first time off this support level, but I remembered coming back down and looking at the chart and not getting involved because I didn't like the bearish, the bearish tendencies that were starting to take place here, failing at the 20-day moving average, heavier volume on the selling, lighter volume on the buying. The bounces, not very strong, nothing compared to these bounces we were seeing before, and then breaking down below these prior lows. And you can see volume very strong. So even if you've got a great looking chart, you got a super support area that you're watching, you have to at least recognize the possibility that it is not going to hold. So you want to keep your stops in play. Look at how painful this stock would have been getting in at 42.5 if I just said, oh, I'm at gap support, I'm just going to hold. The next 4 weeks would have been pretty painful, dropping from 40, here all the way up 43 and change down to 36 and change in 3 or 4 weeks. So you want to be careful. Make sure you keep your stops in play. All right, ABM. Here you can see, this is the gap I'm looking at here. So here's the gap. You go all the way up and establish a high close, come back down. So that's kind of a resistance area. As you pull back, we actually printed a nice reversing candle. Look at that intraday move below gap support and then the reversal. That is telling you, again, I think that tells me that market makers are likely with a long position, because if you're breaking down intraday, who is going to buy a breakdown? I'm not. Most traders are not going to. The only reason for reversal would be market makers buying on that dip below support. That's a lot of times how they create inventory to go long, is prices drop below support. They're not buying at support. They allow all the stops to start triggering, and that's where they accumulate on heavier volume, and then they reverse. They're buying into the close, and you can see over the next several days, we had a nice move up. Didn't quite get back up to resistance, but if you were trading that, probably could have had a 8-10% move in less than 2 weeks. Five Below, FIVE. All right, now this one actually on a couple of occasions, this one did. This was a gap support over here that I actually traded and ended up getting stopped out just barely, but I didn't like losing that support level right here. I think I lost a couple of dollars on that one. But look back to the prior gap up and this little tail coming down. Look at the volume. So the selling that took place intraday. Remember, you get the gap up. Market makers are on the sell side, but they could only take it down to about $95, and then the stock closed at 99. So that tells me that the buyers were out there around $95. Well, look at these the next 2 months. If you're patient, instead of chasing at 105 or 110, you could get the stock right back down near that 95 level, keep a tight stop, and then have an opportunity to ride the stock on the next push to the upside. G3 Apparel Group. Look at the gap up here with heavy volume. Now look at this candle. This is a black candle off of an uptrend. A black candle is a reversing candle back to the downside. And what it's telling us is we're getting a huge gap up to $50 from the prior close around 43. But I would say market makers were able to get control of this one because we did finish well below the high. We went back up a couple days. Volume started drifting lower, couldn't get through, and we ended up a few weeks later coming back down and testing this gap support. 3 times intraday we went below gap support. All 3 times came back up above and held. Again, I think that is accumulation. The stock makes another move to the upside, and you can see with the exception of this one day in mid-August, that was a level that held for the next 4 months, and this was a trading range that could have been traded. Although that candle here would have been earnings related, I would not have been in on that. But again, it's just waiting and allowing prices to come back to key support levels. And now, if you notice, after breaking down in October, look at where we're struggling to get through. That same earlier support level is now big resistance. And look at that false breakout there and what happened afterwards. Stock comes back down. So false breakdowns are bullish. False breakouts are bearish. Casey's General Store. Look at the big volume here. Huge volume. Gap up. Stock opened at 120 from a prior close around 116 and change. Went all the way up to 130 intraday. Still managed to close at 125. 130 was tough. Next couple attempts up, couldn't get through. But notice where this last tail came down here on October 29th. If you wanted to wait and get in at 120, you could have done it right there. And literally, we'd have been right back to the top of the range. I would not have been looking for that breakout. I would have just been trading back up to that 130 area. I did not own this one, unfortunately. But again, if you follow it, you happen to catch it at the right time, it's a really nice short-term trade. Kroger. Now, Kroger, after gapping up back in June, look at the volume here on this gap up, move higher. And again, look at where the tail came in. That's where the buyers were. And when you come across here over the course of the next 5-6 weeks, multiple tests, never broke below, at least not on a closing basis. And we ended up turning back up to the upside. So this tells you accumulation. Market makers couldn't stop it. Comes back down, consolidates on lesser volume. And then I think once the inventory is balanced out, then we start moving again to the upside. Another thing to do potentially with these stocks is, I'm talking a lot about gap support, price support, but also moving averages. If you get a stock that gaps up, sideways, consolidates, and then starts trending, remember that rising 20-day moving average can provide pretty good support. Now here at the very end, it didn't hold. Number one, I think we had another earnings report that came out, but also at the top here, look at this, higher price, lower PPO, negative divergence on that breakout. Volume, not exactly huge either. So signs of slowing momentum to the upside after that advance on Kroger. All right, Darden Restaurants. This is one that I think this may have been a setup a few weeks ago. Stock made a nice run. It's in that restaurant space, so it's in a really good space. But you can see right now it's just sideways consolidating. And I know, this gap was all the way back in June. But if we break below these moving averages, we've got support down here around 103, 103 and a half. But I wouldn't be shocked at some point if Darden were to get all the way back down into this area around 99 to 101. Very, very heavy volume, a lot of buying in this area. If we were to make our way, meander back into that zone, I could see a very nice, solid reward to risk trade developing. So even though this is a stock that had the gap up several months ago, if I was keeping a watch list of gaps, this is one that I would certainly hold on to and see if it comes down. You could wait and see if you get a false breakdown. That's one of my favorite trades, is to get that false breakdown, come back up above, and then look, maybe 8-10% move to the upside. Steelcase. All right, big gap. Look at this, all the way back in September. No chance it's going to come all the way back down to 16 from 19, right? Wrong. About 4 weeks, came back down to the 16 level, hit into the support area. And the lines, I think the first line here is the gap support. And the second line here I just drew because that's where buyers off of this downtrend came in, and we saw that reaction high. So this area is pretty good support. Could get all the way back down to the top of this gap support, down at 15.5, but I wouldn't be surprised to see a reversal here. This is one I'm kind of keeping my eye on. If we get a intraday break below and we start to rally off of that, that could be a pretty good sign, similar to what we saw here, where we had the breakdown below this gap support and then rallied back. And you can see over the course, once it came back up above 16, that's almost a 10% move in about 5 trading days. Helen of Troy. Well, you've got the gap up here. This is a little bit of a different picture. That's why I wanted to show this. Here we gap up, we move up, we come back down, and we break below the top of gap support. Now, if I had seen that, I would have been thinking we're probably going to go back and fill this gap. But notice we got a hammer, and we printed this tail to the downside to mark short-term support. Then we went all the way back up to 120, couldn't get through, so clearly we have resistance there. And look at the next push back to the downside. We went back to 110 again. Now, at this point, you can get in fairly tight stop, and you know where your resistance is, up near 120. And here in about 7 trading days, probably 8 or 9% move. And eventually it did get to that 120 level and above. But again, the trading, not just with earnings, the gap higher, but also the next few days sometimes can establish a nice trading range for you to watch as well. Danaher, DHR, gap up from 98 and change up to 106. Don't chase it. Black candle, came all the way back down. Got within probably 50 cents of gap support after gapping up 750 higher. And look what happened afterwards. Nice move back to the upside. Don't know how long I would have held if I had owned it, but I know I wouldn't have had a whole lot of downside. And that, again, is pretty critical with trading, any kind of trading. All right, MGIC Investment Corp, MTG, gap up, very heavy volume. The tail produces that support zone right in here, $11.70 to $12. Now, it eventually didn't hold. And again, you got to have your stops in play. First test did, though. This is a stock that went just below $12, came back up, and it ended up going up 10% in 3 trading days. That is not a trade to sneeze at. I know you might look at this and say, well, it eventually went lower. I'm just looking to trade, to get a quick pop. I'm not looking to buy and hold and marry a stock. So that's just my strategy. I know many of you do like to hold longer term, and that's fine. Everybody has their own style, strategy, reasons for doing that. But for me, I'm short-term trader. So this is the type of setup that I'm looking for and I'm waiting for. That's why I keep this chart list. Hundreds of stocks in it. Intuitive Surgical. Well, I think if you go back, I think it's pretty clear to see price support. And that was the main thing here. 2 lines. One is the bottom of gap support right here. We went through that, but price support held. And the thing is, we have now hit that three different times since breaking out in June on pretty good volume here. And so I would say that this 470 level on a closing basis is very significant. Maybe go down to 460 on an intraday basis. But this is a really important zone for a stock that's been a really clear outperformer for a long, long time. So ISRG established a high at 580. I think has established a support level now at 470. And that's the trading range that I would be looking at. PayPal. Look at PayPal just recently gapping up. The blue arrow marks the gap up with earnings. We kind of traded up. We just came down and put in this tail down to this price support level, reversed, held gap support, and now we're starting to move up. This was actually the setup for this week that I featured in my blog earlier. Big move here on PayPal, back to the upside. 75 to 77 range, I think, is pretty solid support here. Atlassian Corp team. This was one of the best performing software stocks until October, when many of these high growth technology companies started getting hit so hard. $97, $98 came all the way back down, but notice where it found support. Here was the earnings report where it had gapped up. The gap support is about $67. We went from 97 down to 67 and literally turned on a dime, up 10% about 3 or 4 trading days. Came back down. You can see gapped below. Again, I would be looking at that saying there's no way I'd be buying on a gap below support. And it starts to move down to 65 and then it reverses. And literally, once it comes back up above that level, 66, 67, 10% move in 3 days, back up near resistance. So it's really critical not just to watch gap support, but also price support and these candlesticks where you've got these intraday moves below. You come back up. The beauty, again, is even if you're wrong, if let's say you get in here at 67, you've got to stop at 65. If you're wrong and it turns back around, you lose 3%. If you're right, many times you'll get that 9, 10, 11% move back up to resistance. And it's that accumulation of 11% or 10% or 9% winners versus 2 or 3% losers that eventually builds your capital. All right, just a couple more here. Let's take a look at IPG. This is actually one I own. So here we gapped up. Look at the volume back in October. The clear support area, in my opinion, is 22.60 to 23. Stock goes all the way up to 25. Look, it fails at resistance. Pretty key resistance. So I know my resistance now is at 25. I know my support is in here at 22.60 to 23. And look at where we closed. And look at the volume. This was back on Friday of last week. Holiday shortened session, light volume, just kind of moves right back into this support area. And now the last 2 days, nice move to the upside. Stock's up about 5% in 2 days and continuing to move higher. Procter & Gamble, this is one just to keep on the list. This is a possible trade off the 20-day. I'm not a huge fan of trading the defensive stocks simply because they don't move as much. But if you want to be a little safer, they do provide more safety. I would watch the 20-day, though, because I've shown you on many charts where once you fall below that 20-day, you tend to meander your way all the way back down towards some key gap and price support levels. And the key gap support level, you might think, well, we'll never go from 92 down to 84. But again, I think if you look at enough charts, you'll see that it happens all the time. So this is a key level if we were to get back down there. All right, OFG, Oriental Financial Group. Here you can see the gap up back in July, increasing volume on this push to the upside. The tail comes down to establish that low. I could have even drawn this support level back at the prior low, which would have been the bottom of gap support around 1450. But notice after 2 months of declining, what happened to OFG? It bottoms there, starts to make a move. This may have been earnings related right here on this candle. So if it was, I probably would not have been holding, but it reestablished a nice move to the upside. And if it comes back down, I think it's pretty clear you've got nice support around that 15 level. All right, last one I have is Biogen, BIIB. Here you can see the huge gap up, 2 big gap ups back in July. And notice the bottom of gap support. This is one that if you're at 300, the stock goes up to 350 and then to 390. You're probably thinking, all right, this is not going back down to 300. Well, 3 months later, it went back down to 300. Actually went a little bit below where, again, I would not have been a buyer, and yet it comes back up above, and look at the resulting move to the upside. So when you get these false breakdowns, I think you got to be ready with a fairly tight stop. You got to be ready for a recovery. So my items of importance when I'm trading, these are some of the things I look for. I look at the candlestick on the gap. Is it a black candle? Is it a hollow candle? Does it continue moving higher after earnings? Because I think that then establishes probably the top of gap support being very important. The volume on the gap. Now, I went over a lot of earnings related gaps, and they are generally going to have very heavy volume. But I think that's really important. If the volume's not there and you just have a gap up because something else going on in the market, I would look probably 8 times out of 10 for a gap fill. Price support and resistance, talked about that quite a bit. Moving averages, if you want to short-term trade these stocks that haven't pulled all the way back, but they're coming back and testing that rising moving average, you could always take a chance. But again, you want to keep that stop tight. Take a look at relative strength stocks or industry groups and just see how they're performing relative to their peers and how their peers are performing relative to, say, the S&P 500.